Hello traders, what's going on? So this video, I will be going through my analysis on Snowflake, and I'll go through the short position that we currently have and what is the path forward, what are the certain actions and certain follow-up stuff that you need to do going forward, because Snowflake earnings is going to be coming out in 3rd of March and you need to be prepared so you don't get caught off guard. Okay, so before I go into all the technical aspect, right, let me just go through why this Snowflake short trade setup was chosen. It is not just simply looking at the chart and then like, oh, the price is falling and then anyhow enter like that. No, that there are some thorough analysis that is being done before I choose this counter. And another thing I want to disclaim is also that this analysis, right, it was done quite a while back, around somewhere like early February, before I have the short position. So please do not think of this as after I enter the short, then now I'm trying to pick up all the bearish buyers or this thing coming in. Okay, so it is quite a lot of information involved, and previously I did not really have the time to make this video but given the current state of the stock right now, I think it is a good time to go through some justification on why this particular counter was chosen for a short position. So all the follow-up actions, what I'm going to do, right, is mainly for myself based on my trade strategy and based on what I plan to do. So whether if you are going to follow or not, that is entirely up to you, and you have to do your own due diligence, mainly because I do not know how much you are risking. You could have a $5,000 account and then you CFD like, I don't know, to 30, 40 lots of Snowflake. If you are in that position, right, then maybe my plan is not going to work for you. I have no idea how many short position you have, how many long position you have, or maybe you can have a portfolio with 100% short position on technology counter. I also don't know. So please do your own due diligence a bit and do not blindly follow. That is my best advice that I can give right now, because I notice a lot of people, when they see a certain trade setup, they just close eye and trade without really like even taking a moment to read certain things. Okay, so please guys, read a bit, please be responsible for yourself. Okay, I can give you guidance, certain price level, but ultimately do take care of yourself. So let's go through why snowflakes were chosen. So let me go through this spreadsheet that I have here. So I have all these numbers that I have taken extract from the earning result from all different companies. You can see there are Amazon, Salesforce, Oracle, Snowflake, CrowdStrike, Cloudflare, Palantir, and Couchbase. So while the original analysis for Snowflakes was done like early February, right? For this video, I actually put in Palantir also, mainly because Palantir final year result have come out, and I think it is good to take a look at it also. But regardless if Palantir is here on this analysis or not, it doesn't change the original decision of going for the Snowflake. So first thing that you are going to see that immediately jump out is the market cap. So all these companies are arranged according to market cap. Amazon obviously having the biggest market cap, right? It is right there at the front. And Couchbase with the smallest market cap, it is at the back. So Amazon should not be on this list, mainly because I believe it is like a $1 trillion market cap company that have quite a robust business structure, even though the cloud, the AWS service of Amazon is quite I would say substantial, but it is there to prove a few things. It is there to compare and contrast how a company that is already beyond the growth stage compared to those that are still in the growth stage. So yes, you heard it right. At the current stage that Amazon is in right now, right, I don't think it is a growth company. I think it has achieved its maturity. Of course, that doesn't mean that Amazon in the future cannot go up. It can still go up, but it's not going to go up like 100%, 200% like it used to. I think the price going up will be slightly slower. I think it will be in the kind of like something like Microsoft, Apple, those kind. I think it has reached the peak of its growth already. So it is now in the maintenance mode. Okay. So and another thing you will notice also is that the earnings, that after a certain point you will see there are those counter at the back, those 5 companies at the back, right? They don't really have any earnings. Only the first three companies have some form of net profit in their business lah. So if you want to like look at it in a very vague manner, even though it might not make sense, you can kind of say that maybe beyond market cap of 200 billion to 100 billion, right? There's a cutoff point where the company suddenly become profitable. So there is a threshold where you will become profitable, or the company decide to go for profitability rather than revenue growth. Okay. And another thing that you can kind of see is also this row that I have highlighted, market cap over trailing 12 months revenue. So because of the fact that the 5 companies at the back doesn't have any earnings, right? We cannot really use PE ratio, price to earning ratio, to kind of like compare the valuation, since the PE ratio will be negative. But we have the second best thing. We can actually use the market cap. So market cap is a reflection of your share price, since market cap equals to share price times the number of floating shares that are available in the market. So it is essentially your share price. Okay. Then we can divide it by the trailing 12-month revenue. So we look at what is the past 12-month revenue that this company is making, and whether they are profitable or not, we don't care. But we just use the revenue and we divide, and what we have is we call it the sales multiple, the amount of sales that you are making compared to your market cap itself. So obviously, the higher the number, it means that the more overpriced this current company share price is. So by comparing all the market cap over trailing 12-month revenues, right, something will immediately jumps out. Snowflake immediately jumps out because it has a market cap close to 90 billion, okay, 90 billion, but its revenue, right, its revenue is ridiculous. It's extremely small. Its revenue is extremely small. We are looking at trailing 12 months. We are not looking at this revenue here, because this revenue is actually the latest their latest financial report. So at the time of making the video, right, Amazon already released their final year results. So this number is for their entire year. This revenue is for entire year, 4 quarters. But for quarters like Salesforce, Oracle, Snowflake, they only release until like their third quarter, second quarter, third quarter. So we can't really compare this number in a side by side. It doesn't really make sense. So what we are looking at is we are actually looking at the ratio. By comparing the ratio, right, it makes much more sense. So when I am calculating this, right, it's actually the trailing 12-month revenue, which is not here. So you can see that this 87.34, right, is your market cap, which is E3 divided by 103, I think, billion. So this 103 is actually from the trading view. You can see here trailing 12 month, okay, trailing 12 month revenue. Okay, so it's not this it's not the 9-month revenue. Okay, so just want to make clear. So just from this alone, you can see that the Snowflake actually is one of the most overpriced counter right now. And another thing I want you to look at is also take a look at the operational expense. this line here. So in this line, right, I'm looking at operational expense as a percentage of the revenue lah. So it means that for like you make this amount of revenue, what is your operational expense that is required to run this business, meaning your salary lah, your workers' wages, raw material, research and development, marketing, sales, all these things lah. So after you, so I want to see how big is this operational expense as part of the revenue. So what you will notice is that it's actually quite high for for this cloud business, right? The operational expenses is actually quite high, and you can see that Snowflake, Palantir, and Couchbase, right? They actually exceeded the operational expense, exceeded the revenue, meaning they are making losses, and it is one of the reasons why they are still making losses lah. So for CrowdStrike and Cloudflare, it is also quite high, somewhere at 91%, 96%, right? But I think the reason why they are not making any earning is they probably have other non-operational expense that are coming from somewhere else lah. So that's why they do not have any earnings right now also. But you can see that Snowflake actually also have the second highest operational expense. The highest one is Couchbase. Okay, so another thing which is not very important that I want you to look at is also the R&D expenses. The R&D expense at a percentage of your operational expense. So let's say your company is spending $1 million on all the operational stuff, and out of this 1 million, how much is it going into R&D? So that is this number lah. And you can see that for growth counter like Snowflake, CrowdStrike, Cloudflare, Palantir, Couchbase, you can see the number is actually quite high, somewhere around above 32% for Snowflake, which is the highest. CrowdStrike at 30%, then Cloudflare and Palantir slightly lower lah, 28.7%, and Palantir is at 24%. But even Palantir, the lowest at 24%, right? It is still higher than the first three counters that you are seeing. In fact, Amazon actually have the lowest R&D expense at 12.6%. And similarly, right, if you look at marketing, maybe Salesforce is a little bit I would say an outlier. If you look at Amazon and Oracle, Amazon actually spend only 7% on sales and marketing lah. Oracle spend 21%. But if you look at the growth counter, right, they are spending quite a lot. Snowflake spending 50% on sales and marketing, CrowdStrike spending 52%, Cloudflare spending 52%, and we have Couchbase spending 54%, and we have Palantir spending 38%. So you might be wondering why Palantir actually spending so little here, which I will kind of like explain later. Because one reason is this Palantir already released their final year result lah. So the numbers that you are looking here is a little bit more updated, a little bit more live, whereas Snowflake earning haven't come out yet. So these numbers are like last quarter result numbers lah, so a little bit outdated. Okay, so the R&D and the sales and marketing spending, right, is one of the reasons why I believe Amazon is no longer in the growth phase, because at some point when you hit a revenues that is so high, when you reach a market cap that is so high, right, you need to reduce your expenses to make money. You need to reduce your expenses to be profitable. Okay, and if you look at Snowflake R&D expense, right, for the 9-month R&D expense, it comes in at about it comes in at about $343 million. Okay, $343 million. And if you look at the revenue, Snowflake only makes $835 million. So meaning Snowflake is spending close to about 41% of the revenue they make on R&D, and Snowflake is spending Snowflake is spending I don't have the marketing to revenue, but never mind. Snowflake is spending $540 million on sales and marketing, which is more than 50% of their revenue, meaning they are really going for that super high expense, super growth lah, okay? But at some point, right, they need to cut back on their marketing and R&D so that their operational expense doesn't exceed their revenue, and eventually they can start to make profit lah. But since they are in the so-called growth phase, right, they are still able to, they need to spend this much on this 2 portion of their expenses lah. And maybe if we look at Snowflake in like the next, I don't know, maybe like 5 or 6 years, right, you might start to see both R&D and marketing expense start going down, maybe towards the level of Amazon, like that lah. So on its journey from becoming growth to being mature, right, you will start to see R&D and marketing expenditure start to go lower and lower lah. Okay, so that's one of the reasons why I believe Amazon is no longer in the growth phase, and we cannot expect Amazon to behave like how it behaved 4 to 5 years back, where it just shoot up like 1000%. It is no longer going to be in that kind of environment already. Okay, so that's simply just comparing some of the popular, well-known cloud-based company, and also we include a bit of other big companies like Amazon to just compare and contrast a bit lah. And another thing I want you to look at is the average. This is the market cap over trailing 12-month revenue news average, which is this row. So I took the average of these 5 companies, okay? So I didn't include Amazon, Salesforce, and Oracle, because obviously they are like $100 billion market cap lah. So they are in a class of their own. So it wouldn't be fair to include them. And in fact, by not including them, right, it is actually a more conservative case, okay? So just by looking at the 5 growth cloud companies, and if I take the average of these 5 values, right, this sales multiplier, the average comes to about 39.85 like that, okay? Meaning that means to say that Snowflake is actually twice as much as the average multiplier, meaning it is twice as much as overpriced. So in order for Snowflake to come back to the level where it is in line with its peers, or come back to that so-called the sector average, right, it need to do 2 things. Number one, it either grow its revenue by another 100% in 2022, or its share price fell by 50%. So if either one of them happens, right, then Snowflake average will be somewhere around 38, so like 38.5, 40 like that lah. And what you can see is Palantir, this market cap to trailing 12-month revenue, right, it's like at 14.7. It is even lower than, it is somewhere at the lower end, the 2 lower end between Couchbase, Palantir. These are the low. Why do you think Palantir actually fall so low, or why do you think Couchbase actually fell so low? Because at one point, I can tell you that the multiplier is somewhere close to 80 or 90 or somewhere like that. So if we look at the chart, right, if we look at the chart of Palantir, let's look at Palantir first. It's very easy. It's simply because the share price has dropped by 75% from the top lah, and that's the reason why the multiplier have fell so low. And how about Couchbase? Let's look at Couchbase. Also in the same boat. Price actually fell about 50, 56%, 60% from the top. That's why the multiplier is so low. And perhaps not only that, right? Maybe their revenue is not making so much also. So either maybe both the numerator and denominator are contributing to this low multiplier lah. If I were to do this analysis maybe 6 months ago, right, I will believe this average to be somewhere around 60, 70 like that. But now Palantir and Couchbase have taken the dive first lah. Whereas Snowflake and Cloudflare are still kind of like hanging hanging around there at the top. So let's take a look at Cloudflare and Snowflake. Okay, Cloudflare is somewhere here, somewhere here. It does fall by quite a bit, 64%, 63%. But even then, right? Even then, the reason why it has a very high number is because the revenue is very low. The revenue, since the revenue is very low, right? It gives you a bigger number compared to the market cap. And Snowflake is even worse. It is at 87. But if we look at Snowflake, it have not fallen as much yet compared to Cloudflare. This is like 33%, and at its worst, right, it is somewhere around at 43%. So looking at all these together, right, Snowflake actually does have the biggest room to fall compared to the rest, and this is one of the reasons why Snowflake was chosen. It is not simply just close eye pick and choose whatever you feel like it. There is a bit of work that has gone through into the analysis okay. So there is another thing that I want to take a look at also, and that is what I will call the purchase of short-term investment. So Snowflake actually purchased a lot of short-term investment with its cash. Short-term investment are so-called investment that they are holding and they will cash out within 1 year. So within 1 year, they are going to cash out the short-term investment. So they are not like they are buying a new plant, or they are buying a new equipment, or they are doing some merger and acquisition. Those are long-term illiquid investment. So short-term investment are those that is equivalent to cash, meaning you can cash out anytime. So the kind of short-term investment that Snowflake is purchasing is bonds. So you can go into their financial statement, you can dig a bit, and you can see that they are actually spending $3 billion buying corporate bonds. So my first the first thing that I ask myself is like, why on earth are they buying corporate bonds you guys remember when Tesla bought a lot of Bitcoin, and majority of their profit for one of the quarter is coming from Bitcoin. And if you look at a company that is making cars, and the profit that they make from their so-called investment is more than the profit that they are making from purchasing, they are making from selling cars, right? Then it does kind of like get a little suspicious. But I'm just giving you a comparable example, okay? So let's dive a little deeper to this purchase of short-term investment. There's a reason why I put here, because it is one of the things that I'm trying to measure also. Okay, so let's go into Snowflake and let's dig a little bit on their balance sheets and cash flow. So Snowflake was actually IPO somewhere around 2020 . So that's the first thing you need to know. So when a company IPO, right, they are going to receive a very big influx in cash, a lot of cash gonna fly in. So if you look at cash from financing activity, right, I'm gonna set to quarterly, okay? If you look at the cash from financing activity, let me pick here. You can see that at some point, Snowflake suddenly have a sudden injection of $4.25 billion in cash at Q3 2020. So that is your IPO cash . So they are cash that come from issuance of stock. So they issue their shares to the public, and then they receive this big money . So it is where they IPO. So you can actually come here to look at when did the company actually go IPO and how much cash did they receive from the IPO. So from here you can see during 2020, cash from financing activity jumped by 10,000%. So from 44 million jump to 4.74 billion. Okay, so they actually have 4.74 billion in cash. So imagine you have a business, and then you went public, and you have all your IPO cash of 4.74 billion. What will you do with the money? What are you going to do with the money that you receive from IPO? You probably want to expand your business, or you probably want to I don't know, do something that is related to business. But there's one thing that you might not want to be doing is buying buying bonds. So if you go and look at the balance sheet, and let's look at current asset. Let's look at total current asset. And under current asset, you see cash and short-term investment. Okay. And if you click that, Snowflake actually have cash of 800 million, but the short-term investment is 3.09 billion. Okay, 3.09 billion. So they actually have a lot of majority of their IPO cash in short-term investment lah, in bonds lah. So yeah, so that's something I want to point out. And what you will notice is that this is not just isolated to Snowflake. And that's why comparison is very important, because we cannot just look at something in vacuum, even for technical analysis, right? I always tell my trainees that, okay, you are looking at one chart, right? Don't look at the chart by itself. You always need to compare to other chart that you have at your disposal. Don't make decision in vacuum. So let's come back to this, right? Purchase of short-term investment. So I actually dig out all this kind of short-term investment purchased by other cloud companies lah. And you will see a trend. You will kind of like see a trend. And another thing is I kind of measure the money that is being used to purchase, the cash that is being used to purchase the short-term investment as a percentage of the revenue. Okay, as a percentage of the revenue. Meaning for Snowflake, right? They purchased 3 billion worth of bonds. But for that same period, they only make 800 millions in revenue. And that's not even profit. That's just revenue, meaning you are investing about 4 times more than whatever revenue that you are making at the current quarter lah. So if you look at this particular line, right, you will see that Snowflake is actually like investing almost 3.6 times of their revenues lah, with all their the IPO cash. And Cloudflare is also somewhere up there with 229%. Palantir not really doing any much, but Couchbase is also pretty high at about 74% now. Okay, so if you look at these 3 companies, right, if you go and dig a little bit, they are exactly the same situation as Snowflake. So they have this business, and then they IPO. Then after they IPO, they have all this cash from the IPO share issuance, right? But they don't know what to do with all this. So what they do is they just park them in a short-term investments like bonds. And probably what I feel is that they don't, firstly, maybe they don't know what to do with the cash. So at the meantime, they don't want to like waste, they don't want to waste all the cash sitting around. So they just decide to park them in a bond that probably going to mature in like in 1 year's time. So they get the interest payment, they don't really lose any money. So it's like win-win lah. Then after 1 year, when their bond mature, right, they can kind of like reassess again whether okay, so this year do I need any cash or not, or should I do something with the money now? They have that freedom lah. Then if you look at Amazon, Salesforce, and Oracle, right, they do have short-term investment, but it's not a big percentage of their revenue also. It's not really a big percentage of their revenue. But what you will notice a little bit odd is that CrowdStrike actually purchased nothing. CrowdStrike doesn't do anything with their IPO cash. In fact, CrowdStrike was also recently IPO. Somewhere in like 2019 now. Okay, so let's take a look at CrowdStrike. They recently IPO in 2019, and if you look at the cash flow, like how we go through just now, you can see the bulk of money came in 2019 lah here. Okay, so suddenly from 210 million, they have 770.23 million lah. So yes, that's where they have the IPO money coming in. But if you look at their balance sheet under current asset and under short-term investment, right? Under short-term investment, For 2020, right, they don't have anything. Like if I go to quarterly, right, they literally have nothing, and majority of the cash is in majority of their money is in cash and cash equivalent lah. So they are holding on to a lot of cash. I think at the other looking at another point also, they have some merger and acquisition lately where they purchase something. Yes, here. So you can look at purchase and acquisition, right? During Q1 of 2021, they have 353 million that they spend on merger and acquisition. So it does seems like CrowdStrike is doing something different from the rest of the peers, where instead of using the money in short-term bonds, right, they probably have other plans. And one of the plans is they are doing some merger and acquisition. So they do kind of know what they want to do. They have some plan to spend their cash compared to the others, the other peers. And from another point of view, right, the way you can look at it is also for companies like Snowflake, who is not making earning money. And if you look at the operational cost, if you look at the amount of operational expense that they are spending, right, they are spending 128% compared to their revenue, meaning they are spending a lot more than whatever revenue that they are generating. Meaning it goes to shows that in order to continue with this kind of operational expense, right, Snowflake, despite the fact that they have 4 billion in cash from their IPO, they cannot really use that cash for long-term investment where things are illiquid, meaning they cannot open up a new office, they cannot expand, they can't really do anything drastic. They need to keep that cash liquid so that anytime they need to start paying for their expenses, right, those cash are readily accessible, which is one of the reasons why I believe they are investing in short-term bonds, because as I mentioned, right, after 1 year, when the bond mature, they can review their operational expense again, and they can decide how much money they want to like reinvest into short-term investment again. So they want to keep their cash and cash equivalent liquid, and at the same time they want to earn some peanut through whatever bond investment that they can get. So let's look back at Snowflake. Okay, you can actually see how much money they are earning through their bonds, and it's not much. So you can look at operational income, which is obviously they are not making any income, but they also have non-operating income, which in the form of like interest expenses. So they are actually getting some money. They are getting some money from their interest expenses from all these bonds, but it's very minute amount. 2 million, 2 million, 3 million, and the trailing 12 month is like 10 million. So probably every year they are getting like 8 million, 10 million, 6 million, 10 million. And if you look at it as a percentage of their revenue growth, you can see it is almost non-existent there, because their revenue is somewhere close to 1 billion like that. Okay, so it's not really contributing to a lot in their bottom line, in their total net income. Is almost negligible, but they are doing what they can. Although the underlying message that I want to point out is that the reason why they have so much cash, but they are just using that cash to earn this amount of peanut, right, is they need to remain liquid so that they can continue to support this very high operational expense. And so next, the key thing is, are they doing anything to reduce their operational expense that things can become profitable? Because at some point, they need to be profitable, because you can see from the current earnings, all the nonsense going on in the stock market, right? If the company is unable to make any profit, then they are going to be punished very, very bad, like Netflix or Facebook, Peloton, even Palantir. So the reason why I have Palantir here is I want to show you Palantir latest earning result. Okay, and it is not that they did very bad, In fact, the result was quite impressive. Let's look at this column. Okay, So they grow their revenue from 1 billion in 2020 to 1.5 billion in 2021. So that is about 50% growth, which I believe is all right. It's all right. But what is even more amazing is that even though their revenue grew by 50%, right, they were able to reduce their operational expenses by half. In 2020, their operational expense is 1.1 billion, but in 2021, they managed to reduce it down to 400 million, 411 million. So while the revenue is going like 50%, they actually reduce their expenses by 50% because I believe they know. I believe by towards the beginning of 2021, right? They probably know that hey guys, we need to we need to reduce our expense, like things are going to be very bad, like we cannot continue like this really, and they know lah, they know what they are getting into lah. And you can kind of like see how they drastically reduce their sales and marketing expense, and also their research and development, they reduced by quite a lot compared to 2020. And they also reduce their general and administrative expense. So there's a broad reduction in expenses across the board. Okay, but even then, right, even then at the end of the day, I believe they were still not profitable. There was still a net loss. There was still a net loss of 520 million, 520 million, but it is still a lot better than previous year. It is still a lot better than previous year. But what happened to the stock price? What happened to the stock price? They doesn't care. Stock market doesn't care. Palantir, on the day of the result release, it just jumped down. It jumped down all the way, and the next day it jumped down some more also lah. Okay, so now the question is, how is Snowflake doing the same or not? Is Snowflake reducing their expenses in 2021 or not? Because like even if you grow by a lot, but at the end of the day, right, if you cannot make the profit, right, if you are not able to deliver the profit, then most likely the market is not going to care about your growth really, because I believe whatever growth that like they mentioned they can get, is it has already been baked into the price. So if you look at this December result, right, during December, they released our Q3 result. So during December, they have like a lot of big growth here and there, don't know how many percent, like a lot of quarterly growth, year over year growth, 110%. But the share price is not responding really. The share price is not responding really. Okay, so let's take a look at Snowflake, some of the numbers lah. So here, right, I look at Q1, Q2, Q3 for 2021, okay? So if you look at the revenue here, then this is the cost of goods sold, then this is your gross lah. Gross is revenue minus cost of goods sold, and here we have the operational expense, okay? So if you look at revenue from Q1 of 2021 to Q2 of 2021, we can see that there's a 19% growth. Then from Q2 to Q3, there's a 23% growth. So that is good. That is good. But at the same time, you can see the cost of goods sold also increased together with the revenue. But what you will notice is that even though the revenue went up like 22%, the cost of goods sold only went up by 14%, which is good, okay? And next, if we look at sales and marketing, right? And if you look at the overall operational expense, you will notice something a little bit different. So if you look at the raw number, right, you will see that sales and marketing in terms of raw number, it is going up. But if you look at the quarter to quarter expense, right, it is not going up by a lot really. So from Q1 to Q2, it went up by about 9.6%. But from Q2 to Q3, it only went up by 4%. So they kind of like already know, okay, we need to stop spending so much really. And in R&D, right, in R&D and general admin, you can see R&D went up by 7.5% from Q1 to Q2, but they actually cut back on R&D expenses during Q3. The growth went negative lah. So the Q3 is a lower number compared to Q2. And I believe in Q4, right, this number is going to be lower. They are heading in that direction already. Similarly for general and expense, right, it is also the same. Okay, so you can see that Snowflake also aware of what's going on, and they are desperately trying to reduce their cost lah. So this other expense and income don't really need to care so much. I just put there just CC only lah. It is the income that they are getting from all the bond payment lah. Okay, so in Q1 they get a total non-operating income of 2 million, which is like very tiny compared to their revenue. Then in Q2 they have 11 million in interest income, which is also very tiny compared. Then it decreased in Q3 with like 3.5 million. So just put there only, don't really have to care so much about those. But the next thing that I want to look at also, when we are looking at cost of goods sold or R&D or sales marketing, right? As I mentioned, right, you cannot look at the raw number alone, because let's say if your revenue increased by 100%, but if your operational expense only increased by 10%, right? Then that's a good thing. That's a good thing. Even though if you look at the raw number and see, hey, my operational cost increased by 10%, you cannot say that it's not good. You need to see whether how much did the revenue grow. And on the other end, right, it can also be the other way around, where your operational expense actually went up by 50%, but your revenue only grow like 10%, then that is a signal that maybe your raw materials or your employee salary are a little bit high, or things are running very inefficiently. So these are some of the things that you need to watch out for lah. But in this case, we don't just want to see the raw number, but we want to look at each of the costs, each of the expenses in relation to the revenue growth. Okay, so if you look at the cost of goods sold with regards to revenue, you can see that the percentage is getting lower, which is a good thing. It means that while the revenue is going up, right, the cost of goods sold in comparison to the revenue is like going down, which is a good thing. So in marketing and revenue also, you can see that it is decreasing. It is also decreasing, which is a good thing. And R&D, right, it is also decreasing. Admin revenue is decreasing also. Operational expense is decreasing. Everything is decreasing with respect to revenue, and that is good, because as revenue goes up and up, right, even though your marketing R&D price are going up, it's not going as much as what the revenue is going up lah. So you can think of it from a margin perspective lah. And you can see that they have significantly reduced the R&D expenses also, which is why you will see some numbers here lah. So for marketing and R&D, right, you see that from Q1 to Q3, the difference is 15.77%. So 72.87 minus 57 lah. So it actually dropped by 15.77%. Same thing for R&D. It actually dropped by 13.31%, which is a good thing. Meaning they are trying to reduce their cost lah. Okay. So now here comes the dilemma. So these companies are desperately trying to reduce their costs in order to sort of get their bottom line up lah, in order to make sure that at some point they are able to get revenue. But at the same time, the traders and investors are buying into this counter as if they were growth. Meaning, in order to generate revenue and in order to generate profit, right? A company like Snowflake, they need to start cutting costs on sales and marketing. They need to start cutting costs on R&D. And once they start to cut their costs in all these areas, right, you will see that maybe the revenue growth is not going to be as strong already. So it is like you have to choose like, do you want to grow some more the next year, or do you want to make profit? So at some point they have to choose, And because currently Snowflake is priced in a way where it is a growth company, and now they are trying to reduce all these costs to ensure that they can make profit, right? It can be a situation where even though they are reducing costs, they are still not going to be profitable, much like Palantir. Even though they drastically reduce their operational expense by 50%, right? They are still not profitable in the end. So they are caught in between while the revenue is still growing. But they might miss their profit guidance, or they might miss their EPS guidance. But at the same time, right, because they are reducing all these R&D and marketing, right, they might also miss their revenue target. So they are no longer growing as much as what the market expect, but somehow they still not manage to be profitable. So they are caught in this very weird space. They are caught in this do or die kind of like area where whatever they do, right, the market is not going to be happy. And if you look at, once again, right, if you look at the market cap multiplier compared to the trailing 12-month profits, right, Snowflake is trading at 87 times whatever the revenue is making. So it gives you a very big hint that Snowflake is probably one of the most overpriced counter right now, and the numbers are like not really adding up also. And you can see from how they utilize the IPO cash, right, is they are telling you that, hey, actually we can't afford to expand so much. I think in the next 1 or 2 years, we can't afford to expand so much really, and we might want to cut down on the cost a bit. So that's why they are trying to keep their IPO cash as liquid as they can, but at the same time, they are trying to earn peanuts here and there also. And if you compare Snowflake to CrowdStrike, right, I kind of feel that CrowdStrike is currently not really good to short really, because they are somewhere around the mean level really, and also because of the fact that they are not really utilizing their IPO cash. Maybe they do have some plan for it for some other merger acquisition on top of the current merger acquisition that they have taken, meaning it kind of tell the investor that they do have some confidence that in their ability to generate cash in the future, and that's why they are trying to do some merger acquisition in the current year lah. Okay, so these are some of the, I would say, qualitative analysis that you are not going to get from reading the chart, or you are not going to get from just looking at Snowflake numbers. You need to kind of like compare across the industry and the peers to see whatever things that are happening at the moment. Okay, so next, right, let's take a look at the presentation that we saw just now, because in this presentation, they did reveal something. They did reveal something. So fiscal 2022 guidance, okay, fiscal 2022 guidance is they expect 104% growth in year 2002. Okay, so this is 104%. So Snowflake is very funny. So currently they are in the fiscal year 2022 already, even though currently we just entered 2022, right? They are already in the fiscal year 2022. So this 104% is like, is referring to here lah. So the moment they report here, right? The moment they report here, their guidance is they should have 104% growth lah. So when we look at the trailing 12 months, we are like somewhere there already. We are already at 73%. So if let's say Q4 result come out, the revenue very good, and we hit the 104%, right? Then that's very good. That's very good. They meet their expectation, whatever. But the key thing here is that this number here is using the trailing 12 months, meaning this number has already baked in 100. We have already baked in this 104% growth. We have already baked in that growth into this number already. That is to say that this number, right, is we are already assuming when the result come out, they will achieve that 104% growth. So even if they have that 104% growth, right, the earning multiplier will still be very, very high. Meaning by their next fiscal earning, right, they actually need to increase another 100% more revenue in order to get this number down to the average. Okay, so just be mindful of that. We are not looking backwards, we are kind of like looking ahead. So if on the earning date they announce what the revenue meet for this year, everything good, everything sweet, you may think that share price might shoot up or what, but maybe it might not. But let's say if they announce their forward guidance for the coming year and they say that, okay, we only expect maybe 80% growth for the coming year, then that is going to be a very bad news. That is going to be a very, very bad news, because currently the share price that it is trading right now, right, it is kind of assuming that in the coming year they can grow another 100+%. But if during the earning result release they come out and say that, okay, maybe we only expect like 70%, 80%. So if you look at the raw number, wow, 70-80% growth is shock. But if you compare to the valuation to the peers, right, 70-80% growth is for the coming year is not what the market is expecting. And because of that, right, there is a good chance that the share price might drop quite drastically to the point where it need to be sort of like somewhere at the mean level, Okay, so that is basically my analysis going forward. And that is one of the reasons why I am bearish on this counter, because of all the reason that is being explained. The biggest reason is that it is overpriced. Even if I account for the fact that at the end of when the earning result come out on March, they managed to get 104% growth for this year, right? The price already expected that. The price multiplier that we see here already expected that. They need to do even more. And if they give any sign of negative guidance in the coming year, right, most likely the share price will drop. Okay, so that is the analysis portion. Very fundamental based. But of course, the chart also have to prove our fundamental. And the way I see how the chart proof is that by November, when everything is like all rosy, all this and that, the price is not responding really. So the chart, and of course from the technical aspect, we also see trend line being broken. We also have certain levels being rejected here. So now, because the price has also fallen recently, the price action, the resistance, the trend, whatever, all these things, all of them are like kind of aligned together. So that's the reason for the short position. And that's the reason why Snowflake is chosen instead of CrowdStrike. So I do have a lot of people asking me, CrowdStrike can short or not? And then like, if I say no, then and if they ask why, it's quite hard to explain within like 5 minutes. And I think this video have been probably for like 30-40 minutes. I think close to 40 minutes already lah. And it's quite hard to explain. It's quite hard to explain. Okay, so I hope you guys can kind of like follow through the thought process in this analysis. But of course, at the end of the day, right, these are my analysis, my opinion, my takes on what all these numbers mean. I could be wrong, and if I'm wrong, right, then of course get the hell out lah, cut your loss lah. So one thing you do not want to do is, wow, like, wow, Zol did so much analysis, this and that, I'm gonna just YOLO short everything, confirm earn. Please don't have that kind of mindset, okay? Please do not have that kind of mindset. That's the kind of mindset that will make a trader forever be in that non-profitable state. You have to be a little bit more responsible for your portfolio, because on the portfolio level, right, I don't know what you have. If you already have like 5 tech short position, right, then no matter how good my analysis is, it's not going to help you if suddenly all the tech decide to rebound due to some external stuff that happen. Okay, so now let's go through the trade plan. Okay, let's go through the trade plan on what we can do. So we have a short position at 295. I'm not sure what is the price that other people get, but I managed to get in at around 298 lah. I mean, it's a very tiny difference. In my eyes, it doesn't matter. If you think this matter a lot, and if you think this is a difference between you making a big profit and you not getting a perfect entry, right? Then your idea of trading is wrong already, and you might need to readjust how you look at trading in the first place lah. This small difference of 0.75%, and considering how volatile Snowflake is, right? This difference is nothing. Okay, this is like not even a n byte difference like that. Okay, so the entry was somewhere around 295, and the price is now at 273. So the stop loss that is given to you is 265, which is slightly high, but we need to account for the volatility of the stock itself lah. And also, I do not advise you to suddenly shift this stop loss, because it's quite volatile. It's quite volatile. So for those who have not entered yet, right? For those who not entered yet, I would not advise you to enter at the current price unless you are willing to go for 245 stop loss. Unless you are willing to go for that, or maybe even 240. But if you do that, right, there's a chance that you can get kicked out of the trade and then you lose money, while those who are having 265 stop loss might be still in the trade. Who knows? Nobody knows. But from a risk perspective, right, I think you are a little late. But if let's say the next few days price kind of like retrace a bit, right? Maybe, but I don't know. Maybe you might want to, you can go in at the retracement. But of course, if you see one big green candle, then of course you don't go in also lah. You have to make your due diligence. Okay, please don't be that. Please don't be so naive. It's like, oh, Zor say go in, then go in. Like, don't really care what's the price action is. Okay, please think. Please think. if your decision to go into a trade takes only like 10 seconds, like from the moment you see a chart to your position, it only takes 10 seconds, regardless you are reading, following trade or whatever, right? Then that's wrong already. That's wrong already. It usually takes me about 1 to 2 hours to do a proper analysis, and then another maybe 30 minutes to look at my portfolio and to see how much lot sizing, or whether or not even if I can take this trade despite my analysis. It is another like 15 to 20 minutes before I finally like still sit there deciding, okay, should I take the trade with this price action or not? So in fact, I have a lot of counters that are in my shorting watch list, but I haven't taken the trade yet, still waiting around. But there are a lot of people out there who just like, after see a post, just take out the handphone and then start entering the trade within like the next 5 seconds without thinking through anything. Please don't do that. Huh? Okay, so sorry, I digress a little bit. So in this case, right, if you have entered at 295, you are in a very good position. If you enter lower, I mean, I don't know lah. Hopefully you didn't enter at 274 lah. you didn't enter at 271. But if you enter somewhere between like 290 to like 300, I think that is quite a good safe level that you enter lah. Okay, so in the coming days, right? In the coming days, if snowflakes continue to go down, right, it's a good thing. It's a good thing because you can actually hold through the earnings. You can actually hold through the earning. And in fact, my entire analysis is depending on the earnings lah. And I do hope that it have somewhat similar price action to Palantir like that. It can gap down lah. But if the share price like continue to go down prior to the earning, right, it's a good thing because let's say if the earning decide to be against whatever we have analyzed for some reason, like even though they have bad earning, bad guidance, but the share price still decide to shoot up anyway, which can happen, which we see in Peloton and DoorDash, where even though the earnings was bad, the share price still shoot up 20% because of some other factors lah. So in this case, right, if the price fall to somewhere around maybe 245 like that, and during the earnings, for some reason, if the price shoot up like maybe 20%, right, you are still somewhere back to your entry price. Okay, you are still somewhere back to your entry price, and you can still hold on to it. You don't need to suddenly run. You can still hold on to it because it can be very volatile. It can be extremely volatile in the sense that price just gap up, and then after that, the next day it start to gap down really because it's just the way it is like people buy because of all the emotion. Then next day they realize the reality and then they start selling down. Some example that I can give you is DoorDash. You can see earnings come out, go up, then after that come back down to the original price. And Peloton also earning, the price shoot up and then now coming back down already. So if the price fall to 245 level, right, regardless of whatever the result of the earning is, whatever how the price respond, right, you can safely hold through it. Okay, you can safely hold through it. So I'm personally going to hold through this. But if let's say before the earnings come out, price kind of like sideways, even recover a bit, and then there's no sign of bearishness, it's just kind of like hanging around sideways, right? Then you have a decision to make. If you choose to hold through the earnings, your worst case scenario is maybe the whole thing shoot up 20%, right? We use 20% as a rough gauge lah. Okay. Excuse me. Excuse me. If the whole thing shoots up 20%, then you will probably go into negative. From a neutral position, from a break-even position, you will probably go into negative, but it is still below our stop loss. It is still below our stop loss. It can be that price can actually U-turn and come back down. We don't know. It can happen. So if you are following the stop loss, if you accept your risk before you go in, right? Meaning you go in with the knowledge that, okay, this trade I'm going to lose this much. I suggest that you can hold on to it also, even if it suddenly get up, because maybe it will start to retrace back down some more. But if you are the kind that like you went in and then you think that, oh, this one confirm win lah, or you just went in without really thinking about your risk, right? If you are in that category, which I truly hope no one is, then you may want to just exit at break even before the earnings, so that if the earning is like against our analysis and it gap up, right, you do not lose anything. But of course, if you do that, you obviously lose the opportunity where if things are bad and if things go along with our analysis and things start to gap down, right, you miss the opportunity for a good profit also lah. So this is the brutal honesty in trading. If you cannot risk, don't think about profit. If you cannot risk anything, right, profit is not going to come to you. If you scared this, scared that, right, there's no profit is coming to you lah. You need to ensure that your risk management is like on the ball, especially during this situation. Okay, so personally for me, however the price is, right, whether it's go down or like stagnant or go up a bit, right, I am going to hold through the earnings. I'm going to hold through the earnings because I already decided that I can risk at this level. I can risk at 365, everything is decided already. But if let's say before the earning, for some reason, price rally until like here, right, then maybe before the earning, I will exit lah. Because in this case, if things were to be against my analysis, and if after the earning, after market hour, the thing shoot up like 20%, right, it will be way above my stop loss level already, and that is beyond my risk already lah, which is why I am going to probably exit before the earning itself. So that is my trade plan, and that is, I will consider this as reactive risk management, where we don't just keep one fixed stop loss, fixed TP there. We need to react a bit lah, because the market is quite volatile and we are holding through the earnings. Okay, so hopefully whether you have this position or not, I hope you can understand the logic and the justification behind certain decisions. So if you are looking at how I'm doing this, right, I'm looking at it from a risk perspective. I'm not looking at the trade to see, wow, this one, if earnings back gap down 20%, wow, I can win like 30K, so this one I trade already, but you didn't really consider the worst case scenario. You only consider the best case scenario. So we do not want to be doing that, especially in this kind of market condition. So that's the end of the Snowflake analysis. I understand it is quite long-winded, but there are a lot of stuff to go through within this, and hopefully this opened the door to some fundamental analysis that you can apply when looking at certain tech counters or some other sector that maybe you are looking to short. One advice that I can give you is never ever look at things in a vacuum. Always compare, even be it technical analysis or fundamental analysis, right? Compare. Because you can look at CrowdStrike chart and you can look at Snowflake chart and you can short both. You can short both, but behind the scene, right, one actually have a lot more weakness compared to the other one, and if you manage to short the correct one, it's going to be a better trade lah. So it is not like during market, when market is bear, right, you just pick all the downtrend counter and just short left and right without any any regards to what's going on, and that usually can result in very bad trade setup, and you can end up losing a lot of money lah. Okay, so that's the end of this analysis. Thank you very much if you have listened until this point here. Hopefully it is as educational as it is a trade setup, trade idea lah. Have a good day, everyone.